Business analysis are made with reports that are called financial statements. There are three main reports, which are the balance sheet, the income statement, and the cash flow. The report that is most used to analyze the companies is the income statement, since it is the one where you can make analyses of the performance of the company, see how the profits or losses were generated, or as the accountants say, the business profitability. We will quickly see the other two reports to have the complete picture, and later we will focus on the income statement. The balance sheet is the report that has the most complete information. It's the one that gives us the total picture of the business. It has three main areas. Assets, which is what the company has. Liability, that is what the company owes. And equity, that are the owner investment plus the accumulated profits of the company. A simple balance sheet is the one we are showing in the chart, where the assets are on the left side and the liabilities are on the right side together with equity. In the image we have as assets the main accounts, like cash and banks, accounts receivable, inventories, and fixed assets. In this part we put what the business has. The rights that the company has. In liabilities, we include the main accounts like suppliers and long-term debts. Here we put what the business owes, the obligations that are held by the company. And in equity, we have the owner's investment and the retained earnings of the business. In this part we have what the business is. Equity is equal to assets, minus liabilities. Or in other words, what the company is equal of what the company has, minus what the company owes. Due to the importance of cash in the business, the part we saw in the previous report is cash and banks. In the assets section on the left, is broken down with more detail in a separate report, which we call cash flow. This report shows the money that goes in and out. Or in other words, the liquidity of the business. What this report does is separate the inflows and outflows of money, segregating whether they were related to business operation activities, or if they were related to investment or financing activities. The sum of the flows of these three activities is called cash flow of the period. Initial cash balance is added to the cash flow of the period to get the final cash balance, which is what we have in cash at the end of the month. And is the same amount as the previous report of the balance sheet has in cash and banks. Another part of the balance sheet of great importance is the retained earnings. That is in the equity section, on the right side. And due to its importance, a separate report is made to be able to analyze it. Which is the income statement. The income statement shows us the result, profit or loss, that the company had in a period of time, which is normally used for 1 month, but can be analyzed by a 2-month period, semester, year, etc. An easy way to show it is as the figure on the right. Later we will see in more detail this report, where we have sales, and we subtract costs of sales, operating expenses, financial expenses, and taxes, to get the net profit. This report is the most used to make the analysis, since it shows us the real result of the business. It gives us more clarity of the profitability of the business, by removing noise from collection, or other situations that doesn't allow us to clearly see if we win or lose. Up to this point we have seen what a balance sheet is, what is a cash flow, and what is an income statement.
Get more free tips and information at CPRQ. Follow our YouTube channel, CPRQ Business Consulting. in our website, or in our Facebook page CPRQ Business Consulting.